Okay, so learning objective 2 is, like I said, sort of the meat of this particular chapter. And when I say meat of the chapter, I mean like the main portion, and I apologize to all the vegetarians in the crowd. But I'm talking traditional, it's just a silly metaphor, so you'll have to forgive me. So basically speaking, when a customer comes into a store and buys an item from the store, right, that store has to decide what the cost of goods sold is, right? Because that's how their income statement is structured, right? Sales revenue minus the cost of goods sold gives them the gross profit. So there are inventory cost flow methods that allow businesses, merchandisers, retailers, a choice on how they want to assign the cost of goods sold for the goods that they're selling to their customers, okay? And so remember, inventory comes in as an asset. It goes out as an expense, cost of goods sold, right? And so it's important that we track how much inventory is coming in at its cost to the business, because when we sell it, we have to subtract out that as the cost of goods sold, all right? So most of the time, businesses have choices. That's the wonderful thing about the rules of accounting, as you know, is there's choices. And the choices that most businesses will follow will be in the last three categories at the bottom of the slide here. They're either going to have a choice to use something called the FIFO method, first in and first out. The LIFO method, the last in and the first one out, or something called an average cost. And this is going to be the focus of this particular chapter. There is a fourth method, specific identification, that they could use, but we're not going to be covering that in this particular class because it's rarely used. We're going to focus on the big picture for you here. Okay, so these are the cost flow assumptions that you're going to be learning about, and it's going to take a little bit of time to get through them, but it's well worthwhile. And you're going to see this over and over again for any business that has inventory. Okay, so of the three cost flow assumptions, there's three choices that businesses have, and they choose which one is best for them. Okay. As you see, FIFO, which is that first in, first out method, is the big winner. Almost half of all businesses that have inventory use that FIFO method, okay? LIFO comes in a respectable second place, okay, with about 1 out of every 4 businesses using that. And then the other methods, including average cost, rounds out the difference. So it's very important to sort of understand why FIFO is such an important cost flow assumption for merchandisers, and why LIFO is a close second place to them. Okay, to understand cost flow, you need to start with the inventory records that a business has, okay? If you do not have the inventory record in front of you, none of this is going to make any sense, okay? Now, this particular record, for those of you that are in the book or following along with the book, this is on page 273 in your textbook, okay? That's this particular illustration, okay? And as you see, the company that we're dealing with is listed first. Houston Electronics is the company. Yes, that's a dog barking, because I think the UPS man is here. So she's going to go, apeshit crazy for a few minutes, and then she'll calm down. And the product is called an astro condenser. Okay, so in this case, it doesn't matter what the product is. It could be, vacuum cleaners or bottles of shampoo or what have you. But just to understand that every business has these inventory lists, okay, for every product that they have. So this is the most important thing you look at when you're analyzing these cost flow assumptions that we're going through. As you see here, for this particular product, and I think this is a truly made up product, they have beginning inventory of 100 units in the store, okay? So they already own those. Those units cost them $10, and that means they start the year with $1,000 of inventory already there of this particular product, the astro condenser. Then what you see is through the year, the business purchases more of the product, okay? So in April, they bought 200 more units of this product, but as you see the cost, right, that's the cost to the business, the cost of each of these units went from $10 to $11, so they went up in price, okay? The cost to the business went up. And so they spent $2,200 on the new purchase. But now, after April, they have 300 units of this particular product in the store, and they have spent $3,200 total amount of inventory of this particular item, okay? I'm gonna go and get my eraser here and erase this so I can show you something else. Okay. All right, back to the pen. So a few months go by, and as you see in August, they make another purchase. This time they buy 300 more of these astro condensers. But as you see, by the time they actually buy these 300, the cost of every astro condenser has increased again to $12 each. So these 300 astro condensers now cost $3,600 to bring in the store. After August, as you see, they have 600 of these astro condensers in inventory, right? And they spent a total of $6,800 on inventory, okay? It's important to follow the flow. That's why I'm doing that with you. Okay. Then, as you see in November, they purchased 400 more of these astro condensers. Must be a nice Christmas gift. At $13 each. Again, you notice that the cost, every time they go and buy these things to bring them in the store, the cost continues to go up. So they spent $5,200 on their November purchase. Okay, but look what happens now at the end of that whole year, right? They have a total of 1,000 astro condensers for sale, okay? And they spent $12,000 in total, that was their cost, for all these astro condensers, right? So again, when you look at the formula on the bottom, the beginning inventory is the stuff from January, right? So in January, they started with $1,000 of inventory. Okay, that's this piece here in January. They purchased another, they purchased $11,000 worth of inventory over the course of the year. That's these three here, for a total of 12. Okay. So that's how that flows. And that goes back to your previous chapter for, you know, how they keep track of the inventory costs and so forth and so on. All right, so I'm going to clean this up a little bit and go to the next thing. So what you should notice is when you take your beginning inventory and you add all your purchases, you are going to get the total units available for sale and the total amount of money you spent on those units. Then your book says, well, how much do you have left in ending inventory? Remember, inventory, this is your asset. Well, you look around, you do a physical count, and you have 450 of these units still in the store. You still own them. And so we have to assume that the 550 that are not there have been sold. And that means that whatever was sold will be your cost of goods sold. Okay. Now, this is where the cost flow assumptions come in. Okay. Because the cost flow assumptions will tell us the answer to what the value is for inventory and what the value is for cost of goods sold. So let's say this particular company uses the FIFO method, okay, first in, first out. Or actually, this is probably a really good name for an accountant's dog, right? Here, FIFO. But nonetheless, putting that aside, in the FIFO method, right, the first ones in are the first ones sold. And so that's the first out, first one sold. Okay. I'm going to erase this piece here. So that would mean that in the FIFO method, if we sold 550 of these things, which ones were sold? Well, the first ones in are the first ones sold in FIFO. So the first ones in are on the top of the list. Okay. So the beginning inventory. So these 100 items are part of the 550 that we sold. Once those items are sold, the next 200 would be sold because we need 550. So 100 from January, 200 from April means we have 300 sold. We need to find 250 more, and they're going to come from here. Okay. So there's only 50 of these left in the store because the other 250 we sold. So we sold these 100, we sold these 200, and we sold 250, not a very good 5, of these. This is the 550 we sold, okay? So under the FIFO method, you know that these 100 cost 10 bucks each, these 200 cost 11 bucks each, and these 250 cost 12 bucks each. So you can actually calculate your cost of goods sold that way. What your book asks you to do is a little bit different. What your book actually says is, what is the ending inventory? And then you subtract that to get the cost. So that's what your book is going to show you. But this is how I was taught back in the day, that you physically count the ones that have been sold, and that's your cost of goods sold, which means that these 400 and those 50 are still in the store, which is what this says. 450 are still in the store. You still own them. Okay. So you kind of have to, with the cost flow assumptions, you have to kind of figure out which ones are gone and which ones are still with you. Okay. So you're going to see that play out in the 3 methods. Okay. So first in, first out means that the first ones on the list of inventory are the first ones we sell to the customer. Thus, first in, first out. In other words, the earliest goods on the list are the first ones we cost out. That's cost of goods sold. So under the FIFO method, and if you're in the book, now we're on page 274. So if you want to go to 274, you'll see this, okay, table. The inventory table is the exact same, okay, as the one I went over with you in detail, which is why I went over it with you in detail, so you can understand it. And here we're using FIFO. And so FIFO means the first ones in are the first ones out, okay? So what your book says is, look, you have 1,000 of these items, and you spent $12,000 on all of these items, okay? So only two things can happen to inventory that you bought. It's either still with you, which is called ending inventory, that's the asset. If it's not with you, it's cost of goods sold. It's assumed you sold it, so you're going to expense it. That's the only two things we can look for in this whole thing, okay? What's left and what's gone. So the book says count what's left. So the first thing they do is they count what's left. And we know there are 450 units left because we sold the other 550. So which 450 units are left if we sold 550? Well, in the FIFO, the early units have been sold. And so these 400 are still in the store. You still own those, right? And 50 of these are still in the store. You still own those. Those are your 450. Well, the 400, you got it 13 bucks each. And these 50 came from the $12 pile. And so your amount that you still have in the store, when you multiply these through and add them up, is $5,800. So if you started with $12,000 worth of stuff, these astro condensers, and you still have $1,500 of the stuff with you, you have to assume the rest have been sold. And so the difference is the cost of goods sold, $6,200, okay? And so that's basically how they would do it. You can check this number mathematically if you wanted to by doing it the opposite way that I was explaining last slide. Which 550 did you sell? You sold all of these, you sold all of these, and you sold 250 of these, which means you sold $3,000 worth of those. And so 1,000 plus 2,200 plus 3,000 will also verify that the cost of goods sold is correct, okay? So whichever way you want to flip it, flip it. But the idea is whatever system you use, you still got to figure out two things. What do you still have in the store? That's your ending inventory. And then whatever's gone, we're assuming has been sold. There's no other way to, there's no other assumptions here, okay? You either still own it or it's gone. If it's gone, we expense it. This is an illustration. This is in also on the same page in your book, 247. This is a beautiful illustration, I might say. I actually have, I commissioned this painting for my guest bedroom because oftentimes when I have guests, they're the first ones in, but they are the first ones out. And as you see here, this is your beginning inventory of $1,000, right? That 100 that you started with. And then you purchased more in April. You purchased more in August, and of course you purchased more in November. And this shows basically the line that the early ones, first ones in, the early ones have been sold. And so they're on this truck, indicating cost of goods sold. They're on the, they're going to be on the income statement. But the ones that are still with you, the 450, 400 of these purchased from November, and the 50 that are remaining from the August purchase are still with you in the warehouse, so they'll be on your balance sheet as inventory. All right, so if you understand the FIFO, you'll get the LIFO. Matter of fact, that's what a lot of accountants tell their kids, get a LIFO. But anyway, LIFO means the last ones on the list are the first ones we cost out, okay? So the ones at the bottom of the list are the ones that we sell first. So let's take a look at our chart again. Now we're moving on to page 275, if you're looking on the book as well. This is the exact same list of inventory because we're using the exact same list. You can't do any of these things without a list of inventory in front of you. So that's important to understand as well. So it's the exact same list, but this time we're looking at it from a LIFO perspective. So remember, in the LIFO perspective, the last ones on the list, so these from November, are the first ones we sell. Okay. And so we sold 550 of these things, and we kept 450. So obviously, the ones that we sold all of the November purchase, and we sold half of the August purchase, because half of this is 150 plus the 400. So the 550 that we sold come from the bottom of the list, which means that the ones on the top of the list, the 450 units we still own, are still in the store, are from the top of the list, okay? And so again, the first step is, what do you still have in the store? This is how your book approaches it. How much of this stuff do you still have in the store? Well, I have 450 units. Okay, which 450 units do you have? Well, if you sold 400, because you sold the last ones that have been sold, and you sold half of these, you have half of the August purchase left. You have all of the April stuff and all the beginning inventory still in the store. So once you do that and you calculate this through, you'll see that you have $5,000 of inventory in the store. Well, if you started with $12,000 of inventory and you still own $5,000 of it, then it makes sense that the rest will be cost of goods sold. That's step 2. Now, I'll go back and do what I was doing with you earlier. How do you know that the 7,000 cost of goods sold is correct? Well, you can do it by doing the reverse, right? You look at this 400 that you sold, which was 5,200, and you sold half of the August, right? Half of that is 1,800. 1,800 and 5,200 equal the 7,000. Okay, so so you can, either way you want to flip it, as long as you're figuring out both pieces. What's the ending inventory? What's the cost of goods sold? That's it. There's only 2 things to do here, so it's quite straightforward. There's another wonderful illustration. Now I have this in my youngest child's room because he was the last one in. But the way he's looking, he'll be the first one out. And so basically speaking, this is also a very beautiful illustration. Again, under LIFO, the last ones on the purchases from the bottom, right? The November purchase and half of the August purchase have been sold. And so they're gone, right? This is cost of goods sold. It's going to be on the income statement. All the other stuff, the beginning inventory, your April purchase, and half of the August purchase is still with you. So they're still on your balance sheet as inventory. Okay. This is just the graphic way of looking at it, and it's beautiful, don't you think? I think it's beautiful. All right. The very last method is called average cost. Okay. And again, just like it indicates, we are going to find out if we bought 1,000 of these Astro condensers and they cost us $12,000 in total, what's the average cost of each? So that's basically what average cost is. So again, we're going to be looking at the first starting point is again our inventory statement. We have 1,000 Astro condensers. We spent $12,000 on them. So if you spent $12,000 and you bought 1,000 of these things, the average cost of each one is $12. Okay. So it's just a simple math formula. So again, how much do you have in the store? Well, in this case, we have 450 of these in the store. We know that the average cost is 12 bucks. And so the total amount of inventory we still have in the store is $5,400. If you started with $12,000 of goods and you still have $5,400 of that in the store, you sold the rest, that's your cost of goods sold. How do we verify the cost of goods sold? Well, we sold 550 units, right? And we multiply that by a $12 average cost, and you'll get $6,600. This, by the way, is on the very next page, 276 and 277. Okay, so if you're following along in the book, it's just that, the very next set of pages. This is a beautiful graphic illustration. I have this in my master bedroom. It's really quite beautiful here. So here it shows the average cost per unit is calculated, right? We had a $12,000 worth of inventory. That bought us 1,000 of them. So each unit is 12 bucks. And so we have 450 still in ending inventory. That's our asset. We have 550 that were sold. That's our cost of goods sold. So this is the interesting part that businesses have to decide. Remember, they have a choice. Every business has a choice of which method they want to use, okay? And so when you look at our friends at Houston Electronics, and you look at the effects of using FIFO, LIFO, and average cost on their income statement, you'll see something very interesting, okay? First of all, the cost of goods sold, right, will be calculated a little bit different for each one. Because under FIFO, LIFO, and average cost, we are we're using the different numbers in a different order, which means that our gross profit is going to be different for every one of the choices that we have. The best thing to do if I were Houston Electronics, okay, is I would want to pick the inventory cost flow method that gives us the largest gross profit, okay? And so if I were Houston Electronics, I would say that using the FIFO method is the best method for our company because it produces the very best gross profit. And of course, if you follow it all the way down, it also produces the best net income or net profit, okay? And that's probably the best choice. If you use LIFO, see your gross profit's going to be small and your net income is going to be small. And so average cost is in the middle, right, of the two. But I have to show my stockholders, my owners, that I'm a profitable corporation. And we just learned about gross profit margin, that analysis in chapter 5. So obviously the gross profit margin will be largest if I use the FIFO method here. And my profit margin, net income to sales, would be largest if I use FIFO here as well. So for our particular company, the best choice, at least for profitability purposes, is to use the FIFO method. This particular book also says, well, what about your tax? But if tax was everything, you know, which is not, I mean, it doesn't really matter. If tax was everything, no one would want to make any money because no one would want to pay any tax, but that's not the way it goes. Everybody wants to make more money. So tax is just part of the cost of doing there. And so obviously if the taxes are the most important thing, I'd be picking LIFO, but then again, I'd have to explain to my stockholders why my profit was below what they expected. Okay, so we're going to look at the do it exercise number 2 that's done for you in the book. If you are in the book, this is on page 280. and goes over to page 281 as well. Okay, so here we have the accounting records of Shumway AG Implement, so it's probably an agricultural type of company. And this is the information that's given to us, okay? They have beginning inventory listed at 4,000 units. They paid $3 a piece, right? So that's the beginning inventory. So this is the starting point of what we need to know, because everything starts with beginning inventory. Then we add all the purchases that the company has made, adding to this inventory. And as you see here, it's listed uniquely, all in one group. 6,000 units were purchased at $4, okay? So what's the total amount of inventory for sale, okay? Because this tells us about sales, but we don't really care about that yet. We need to know the total amount of goods for sale, right? And so what we have here is we have a total of 10,000 units that were available for sale. Does everyone understand that piece? Okay. 10,000 units is the total available for sale. Now we come down to find out how much of those we actually sold. Okay. So what this is telling us is 7,000 of those units have been sold, which means you have 3,000 units still in ending inventory. Does everyone understand the breakdown there? Okay, I'm hoping that that's the case. So that's one of the things that you have to kind of figure out first here. The sales tells us what's gone. So we have to add what's the total available first before we can see what's gone, okay? And then of course, whatever is gone, the remaining part is ending inventory. So this is telling us here, what does the question ask us? The question's only gonna ask us, there's only two parts to this, any question in this chapter. What's the cost of goods sold, and what's the ending inventory? That's the only two questions that you're ever going to get asked here in this part of the chapter, because that's the only thing these methods will tell us. Okay. Well, under FIFO, the cost of goods sold is which 7,000 did we sell under FIFO? Okay. Well, under the FIFO method, we sold, FIFO is first in, first out. So the very top of the list has been sold first. Okay. So of the 7,000 that we sold, 4,000 of these beginning units were sold as part of that 7,000. And another 3,000 of the second units were sold. So 3 plus 4 is 7. So those are our 7,000 units that are sold. 4,000 units were sold at $3. 3,000 units were sold at $4. And so the total cost of goods sold using FIFO is $24,000, okay? The 4,000 units that are at the beginning inventory and the 3,000 units from the purchases make up the 7,000 units that we sold, okay? So remember, cost of goods sold, you're following which ones have been sold, right? These 7,000. Under LIFO, they want to know the same question, the cost of goods sold under LIFO. Well, under LIFO, the last one in is the first one out. So the last ones in were the purchases of 6,000. So of the 7,000 units that we sold, 6,000 were from, right? These 6,000 went first, because under LIFO, the last ones in are the first ones out. And that means we needed only 1,000 of these, right, to complete our 7,000. Right? And so when you take these 6,000 units at $4 and these 1,000 units at $3, the cost of goods sold will be $27,000 if we use LIFO. And of course, the last method is average cost, okay? Average cost. And so the average cost means we need to know how many units we bought and how much total amount of money we spent on those units. And so this tells you, right, that you spent $36,000 to buy 10,000 total units. So you might think there must be some way of figuring this out. Okay, just waking you up. So that means that the average cost per unit was $3.60. That's the $36,000 that you spent on inventory divided by the 10,000 units. So each unit was $3.60. Okay. Now you sold 7,000 units. We don't really care about the price we sold it at because we're not calculating revenue. We're calculating cost. And those 7,000 units were at $3.60 each. So one way to calculate this is just to do 7,000 times 360. You should get $25,200. What your book does, right, is give you the total amount of money that you spent on inventory, and they subtract out the ending inventory, and that gets the cost of goods sold. That's how your book has been explaining things, right? Total minus the ending inventory gives you the cost of goods sold, right? So the ending inventory, if you sold 7,000 units, you got 3,000 left. Each of those units are worth $360, right? And so when you subtract that from 36,000, your cost of goods sold is $25,200.